All right. Good afternoon, everyone. Thank you so much for joining us today. I'm Lisa Partida with Homemaking LA, and today we welcome you. Thank you so much for taking time out of your busy day. So we have Tom Fuentes with Bank of Hope, and today's topic is going to be your savings. So I'll go ahead and pass it on to Tom.
Thanks, Lisa. I'm not quite sure this is the greatest topic for where we find ourselves in the holiday season, but maybe we have a slight enough time to save a little bit for the holidays, seeing as how going into the spending time. So what I hope to cover is the first four sections of this workshop. The last section is kind of very specific. So this is a long one, but we'll try to cover as much as we can. So yeah, so this is your savings. Um, so in the first section, we're going to cover key terms, what is saving. Um, we're going to explain what savings is and why saving money is important, and then list ways to find money to save. My connection's a little slow. I'm going to turn my camera off so that I don't drop like I did the last workshop that we did. Um, yeah, so section one, is key takeaway. The key takeaway from the section, set aside some money every time you get income. Regularly saving money, even if only a small amount, can make a big difference over time. So first we need to define what savings actually is. So what does savings really mean? Savings means setting aside a portion of money that you earn or receive. But remember, it's not only the job you have too, because money in is a positive in the money in column, meaning that it doesn't have to just be income. It can be money that you receive in the form of gifts. We open saying the holidays are right around the corner. If you receive cash or even a gift card, I say that that's money in. So that could be money that you're not using from your savings to spend, like an Amazon gift card or something like that. Another thing would be like tax refunds. We're going to be heading into the tax season after the holidays. If you qualify for a tax refund, that's money coming in, potentially allowing you to save too. And the thing to remember, and I'm stressing this uh, as maybe one of the most important things that we're going to talk about tonight, savings does not have to be large portions of money. Regularly saving money, even in small quantities, is going to add up over time. Really, the most important thing to remember is time. That's the biggest ingredient. We're going to talk a little bit more about that later. Um, and taking advantage of compounding interest. Um, sorry, one moment here. Let me turn my Teams off here. Um, yeah, so is spending less money the same as saving money? So spending less money is the same as saving money only if you save what you didn't spend. Remember, savings is setting aside some of your money today for use in the future. So for example, if you buy a coat marked down from $60 to $40, it may seem like you've saved $20, but you aren't building your savings unless you put the $20 that you would have spent otherwise into a savings account. But let me tell you, um, still looking after a deal because I really think if you had to buy something, maybe something in the need category, not in the want category, and you were able to save money, that is money in your pocket too. So why save money? Um, you can save money for your goals. You can save money to build wealth, for emergencies, to cover times when you have less income or more expenses. It really creates peace of mind. That could be a goal factor for you. It could help get and keep a job. Um, Several other reasons too. Um, so goals. So think about things like saving money for yours or your child's education. Uh, Moving out of your parents' home, for example, other goals. Um, yeah, so there's quite a bit that there's a lot of reasons that we have. I would put myself in the peace of mind category. I think money issues are probably the number one stressor that we have in our lives. So part of the reason like why I like to have an emergency fund is so that I have that peace of mind knowing that I don't have to rely on a credit card depending on how large the purchase is, of course. Um, but yeah, there's several different reasons. And the other thing I would mention off of these that you see is that you can rank prioritize them as well. If you don't have an emergency fund set up as far as saving money, we wouldn't want to put build wealth ahead of that. So we can also kind of rank order these items in terms of uh, why, because all of these can be goals simultaneously for us. In the participant guide, we have these sections called triads. Check this out after the workshop. Basically, we have a scenario here with Tamara. Tamara works at a local retail store. Her hours vary from week to week. Some months it's a struggle to pay her rent and utility bills. While growing up, Tamara saw her grandma set aside part of her paycheck every Friday at the bank. She thinks it's time to start saving money, but doesn't know really how to start. So in this section, we're gonna ask the questions, where do you think Tamara should start? And how can she find uh, money to save in her scenario? I don't think we have, oh yeah, we have a little bit in the apply it. So we're gonna check the strategies that we have laid out here so that you could think of things that might work for her. For any strategy that helps you spend less, you must take what you didn't spend and set aside where you keep your savings. So there's a whole bunch of different categories that we're going to have. And let me just verbally tell you a few because we're not going to have them here listed, but definitely something that you could check out in your um, participant guide. This is the one I kind of like a lot. So one of them, beyond the brand bias here, is count your coins. I recently did this myself. Um, I cleaned out my wife's coin tray in her car, mine in my car. We both had little jars in the house. So count your coins. So one strategy that Tamara could use is at the end of the day, putting together that a coin jar and then cashing that in at some point of the month, and then putting it into a savings account. We recently did that, and I think we got like $40, so that was really cool. The other thing, if you don't have it already, direct deposit. The savings automatic. So when you receive your paycheck, it automatically can go into your account. Now, here's what you're going to do on top of the direct deposit. Set up an internal transfer to your savings account on a monthly basis. So that way the money is deposited into your account. And you don't have to think about it. And remember what I said, it doesn't have to be large quantities. If our goal in a scenario is to build an emergency fund, for an example, and we want to do that first, transfer $5. Start there. Remember, this is a starting point of, in this case of tomorrow, of like, well, where do we start when we're doing this? Um, the next one that you can't see on here is, do I need it? Consider needs versus wants. Think about the items that you purchase on a regular basis, where you can save money, and then that money that you save, you can add to savings. So my wife and I, about 5 months ago or so, redid our insurance. We had Progressive car insurance. I had it forever, but the rates kept going up. So one of the things that we did, we own a home, but we didn't have the joint, what do you call it, when you combine your auto and your home insurance together? We didn't have it. We were paying Travelers for the house and then Progressive for the car. Long story short, we went to AAA, of all places, sat down with the agent to see if they could save us money. We had just recently got a AAA card within the year. They combined our home and our auto together, and we ended up saving a significant amount of money. We actually now use that money and put it into savings. So um, that's a little bit more specific, not needs versus wants, because you obviously have to have insurance. But just do this in the form of like, okay, I'm gonna look at my budget. How much money do I spend out eating? Can I prepare meals at home? Is that cheaper? Things like that. So just do like a needs wants analysis. Um, well, I'll give you a couple more. Free fun. Uh, the movies are a lot of money these days if you want to go to the theater. Okay, cut back on that a little bit and go to the park. go on a hike, something like that. Look for free things to do. Anyway, there's a whole bunch of other items that you can check out in the participant guide. Um, th Things like as tax refunds, considering renegotiating how much you're saving in your 401k, um, assessing whether or not things that you have fees associated to them, like your credit card. But yeah, you can check that out. So, section one, set aside some money every time you get income. Regularly saving money, even if only for a small amount, can make a big difference over time. And then checking out that scenario that we had in tomorrow in the participant guide will give you and unlock maybe some ideas that you can incorporate into your own um, saving money strategy that you might not have considered otherwise. We also have in section two, we're going to cover where to build your savings, talk about advantages and disadvantages of places to hold money in for savings, explain the benefits of saving money in federally insured savings accounts, and then estimating how long it would to double. So really in section one, we're talking about just like the concept of saving, right? Here, a little bit more practical approach of like the how to. The key takeaway, consider the advantages and disadvantages of savings options before choosing where to build your savings. So where do we put it if we have money at the end of the month? There's several options on where you can build savings. For each savings types, there's going to be pros and cons, of course. Um, Here's a general list: home, friend or family, prepaid card, rotating savings and credit association, savings accounts, an account at a financial institution that is not the same as the account that you use on a regular basis. So the idea, and I don't think we have the pros list here. Oh, yeah, we actually do have it. Let's talk about the pros and cons of each item. So, what about saving our money in our home? All right, obvious advantage of this. There's no fees associated with it. I don't know the last time that you shopped around for a bank in the form of opening a checking or a savings account. But some of them have required minimums that you have to keep in your account. Some of them require you to have, um, uh, yeah, just like different account minimums and either to keep it open to waive the fee. So keeping your money at your house, there's no fees. There's no rules associated with the rules that you would have at a bank. There's no additional cost to maintain. Convenient access, it's literally in your home and it's easy to access. But there's obvious disadvantages, right? Money could be lost or stolen. Money could be destroyed in the event of a natural disaster, whether it be a fire or a flood. And then another disadvantage is easy access. Um, yeah, so home, maybe not so much. Your friends or your family, uh, no fees associated with that. Again, no additional cost to maintain. Could be convenient, especially if the family member or the friend lives with you or within close proximity. May keep you from spending the money. Hey, if I had my mom, for example, be my money manager, my quote unquote money manager, and I kept my money with her, I can guarantee you that my mom would say, Tom, you don't need to be spending money on that, right? So it may keep us from spending money on things that we don't need. Um, Disadvantages, again, loss, stolen, the same thing as the home, can be destroyed, fire, flood, or disaster. The main thing, which is why I think we have the whole adage of don't do business with family, it may strain relationships if something ever happened to the money. So, prepaid cards is an example as well. The money's easy to get, it's electronic, and has online functionality depending on the card that you choose. Can be convenient, might be able to directly deposit wages onto the card, might be able to automatically be move funds from the card to savings as well. One thing to consider on the con side, though, is that there's fees associated with some of these accounts. The You could be subject to theft or loss of the card. Review the card agreement to find out if you're protected from any theft or loss. One thing that's nice about keeping your money in a financial institution is that quite typically there is fraud coverage. If someone steals your debit card information, for example, and racks up a whole bunch of transactions in your checking account, you can file a claim on that. You may not be able to on a prepaid. You might not have federal deposit insurance. So one of the advantages of keeping your money in a financial institution, whether it be a bank that's covered by the FDIC and you're covered up to $250,000 per signer, or if it's a credit union where their coverage is by NCUA, which also gives 250,000 per signer, you may not have that type of insurance here. And why is the insurance important? If the company ever went out of business, that you have the card with, you're not going to get the money back. If a bank goes out of business, you're covered through that insurance. So you wouldn't have to worry about the money that's deposited. You might not be possible to easily move money to savings depending on the terms and conditions. And then there might be an expiration date. You may have to get a new card, and that could be inconvenient. Rotating savings and credit association advantages, commitment to group to save on a schedule, can't easily access money. You can get a lump sum of money at a known date. Disadvantages, theft or loss due to group mismanagement of funds. Depending where the funds are kept, you might not have federal deposit insurance that we already talked about. Group members might not make their deposits when required, and the group may become too large and too difficult to manage. Advantages of a savings account, already said, right? The insurance through the FDIC for banks or the NCUA for credit unions. You might be able to sign up for direct deposit so that the wages are directly deposited into your account. I would say more often than not, this is going to be 100% of the time of the bank or credit union that you choose. Now, I used to work at the branch when I first started out in banking. Let me tell you another advantage of direct deposit. The money is available right away. One thing that I saw a lot when we had our customers come in depositing physical checks is that you're sometimes subject to a hold, whether that be a new account hold because you just opened your account, or maybe you've mismanaged your money in the past and you had some overdraft fees and non-sufficient funds fees that is associated to your account. You may have had an extended hold placed on some checks because of that past activity. Direct deposit totally is available right away. So that's kind of cool. Um, you may be able to automatically move money from checkings to savings. And one of the cool things, like I already mentioned, it can be done automatically on a schedule. So my wife and I have this set up at the credit union that we use. At the credit union that we use, we have $250 automatically swept over from checking to savings. So that's pretty cool. And we don't have to think about it. Oh, and let me tell you why we do this. That credit union account that we have, we use specifically for property taxes. So when we bought the house, we don't have an impound account for a mortgage, meaning that if you have a monthly mortgage, more often than not, your monthly payment is going to be paid to the bank, including insurance and interest and your property taxes. We don't have that with our mortgage is through the credit union. So we have to set aside money every month so that we have enough money to pay the two property tax bills that we have. Anyway, long story short, we have 250 automatically transferred over so that we have money for the property taxes. The other cool thing about saving money at a financial institution is that it's going to earn interest. I can't say that it's going to earn a whole heck of a lot of interest because financial institutions, well, and the overall market right now, the interest rates are a little higher, which means that the savings interest rates are going to be a little lower too. You might be able to find some other areas in terms of other financial institutions, maybe like internet banks like SoFi or things like that have higher interest rates. But long story short on that, the ability to earn interest and have that compound over time is going to be completely beneficial. And we'll talk about that later. Easy access. And one of the things that we talk about a lot in our workshops is establishing a rapport and a relationship with the bankers at your local branch. That could come in so handy because you never know when you're going to need um, extra assistance or a favor. Maybe you're behind on your bills. a relationship with your banker is really crucial. Disadvantages, monthly and recurring fees. There's so many fees associated with accounts these days. Make sure you read the disclosures before signing up for an account so that you know what you're getting into. Not always the best options for saving money for long-term goals because the interest that you earn is a lot lower than other options. The financial institution may not be available, or you may not have access to online banking when you want to use it. And then you may have limited withdrawals at your disposal too. There's some other things that you can do too. I'm going to give you a specific example of what I've been doing probably for the last 2 or 3 years. I'll get to it in a sec. But here's some other options. There's money market accounts, there's certificate of deposits, there's US savings bonds, different types of retirement accounts, IRAs, Roth IRAs, 401ks. Um, you could be a federal employee and have a completely different retirement account. Investments such as stocks, corporate bonds, and mutual funds. So let me tell you about what I decided to do. Now, um, we finally were able to build up that emergency fund. We did that, I would say, 5 or 6 years ago, I would say. So once we achieved that, okay, and we have that in a bank, and it earns a little bit of interest, but we like to have that so that we can have automatic uh, when our checks get deposited from the places that we work, it gets deposited to the checking account, and then we have a little bit of money saved recurring into that emergency fund. Now, outside of the emergency fund, and by the way, this is just the opinion, my opinion, this is just what I do. I'm not saying that you should do this. It's just, this is financial literacy. I'm just trying to give you an idea of options. So I'm not saying that you have to do this. It's just my opinion. But one of the ways that I started saving that actually had a higher interest rate was the money market account. So a money market account is often available from a federally insured financial institution. It's an account that generally offers a higher interest rate. Um, you generally have to keep a higher minimum balance, though, uh, as you know, it's different from a savings account. One of the things I will say that I chose to do, however, sorry about the Teams chat here, let me close it, is that I don't keep the money in a federally insured account. The money market account I have is not FDIC insured, but it allows me to save more money interest rate wise. So I'm able to build wealth a little bit easier. And essentially, what it's comprised of government bonds, essentially, that pay roughly over 4%. There's no right or wrong. Everyone's situation is going to be different, but this is where I choose to save the money um, because it has a higher percentage rate. The other option too that I personally haven't done in a while, but you can also keep it in certificates of deposit. They have higher interest rates than savings accounts. Let me give you a con on that on the CDs though, is that they're time bound and um you have to basically sign a contract saying that you're going to keep your money in the account for 36 months, 40 months, 60 months. If you break that agreement, then you have to pay money back. Yeah, so yeah, it could be not the best, but you earn more interest. Savings bonds can earn a little bit more money. You can purchase them at the Treasury at treasurydirect.gov. They can be had for as little as 25 bucks. And there's a whole host of retirement accounts. I mean, there's 401ks, there's IRAs, there's Roth IRAs. It's going to be dependent upon your situation. I believe right now you can only deposit up to $20,500 into your 401k up to a certain income threshold. Um, and then for the IRA and for the Roth IRA, you can only deposit up to 70, it's either 75 or 7,700. It's within that range, but then you're capped. You can't go above and beyond that. But good sources. Let me tell you another thing that's really nice about the 401k, if you have that as an option. It's kind of a set it and forget it kind of situation. More often than not, these are offered through Vanguard, through Fidelity. These are the financial institutions that manage these types of accounts. And one of the nice things is that they have these accounts set up to be time bound, meaning that you'll invest into a fund based on your target retirement date. So if you wanted to retire at 65 or 67 or whatever your date is, you can invest in a fund. It's automatic. You don't have to worry about it. And the returns are going to be based on the date that you want to retire. So it's like super easy, set it and forget it. The other cool thing is that the money is automatically taken out of your payroll. So you don't have to worry about it. You don't have to do anything. And you can invest like a tiny amount of money. It doesn't even have to be a lot. It can be a tiny amount. But because you set it and forget it, it's going to compound over time. Um, Based on that retirement date. The other thing I'll mention before we move on is that it also can be beneficial for uh, decreasing the amount of reportable income that you have because they're taking the money out before taxes, which is really nice. So if you can do it for tax advantages too. So it's pretty cool. We've already talked about this. We talked about FDIC and NCUA. Uh, just remember that you're insured up to 250,000 with each. But before we move on, let me just tell you, you're federally insured per signer, meaning that if you take uh, me and my wife's account, for example, because it's a joint account, it's 250,000 for each person. So really the account's insured up to 500. Now, here's the thing. This is probably the most important thing that we're going to talk about is interest in compounding. So another benefit of keeping your money, your savings in a financial institution is that you're going to earn interest. Not all accounts earn interest, but for now, we're going to be talking about the accounts that do. So interest is the money financial institutions pay you for keeping money deposited with them. The interest is expressed as a percentage. It's calculated based on the interest rate, the amount of money in your account, and how long it's in your account. The interest that you earn is considered income. So you will have to pay income tax on it when you file your taxes. Compounding is earning interest on the interest. Okay. You earn interest on the amount of money that you deposit and leave in your account. Plus, you earn interest on that interest if you leave it in your account. That's why it's so important not to take money out of your savings to use to spend, but rather use your checking account for that because we want this to compound over time. So, how often interest compounds daily, monthly, or annually makes a difference in how much money you earn. The more frequent the compounding, the more interest you earn. While the effect of compounding isn't large at first, over time, with additional deposits, the effect can be more significant. A piece of homework I would like to give you, aside from checking out the participant guide and the try it and apply it sections, go to YouTube after the workshop when you have some free time and type in the search box. Let me think. How would I want you to type it in? Essentially, the first $100,000 in our savings journey is going to be the hardest amount of money that we save, period. This has been mathematically shown and mathematically proven. So, what I want you to do is go to YouTube when you have some spare time and type in saving my first 100,000. On the search results, what you're going to get is you're going to get a whole bunch of uh, finance YouTube people that have videos on this. Check out a few of them. The reason I want you to check it out is because they're going to have graphs more than likely to show you what happens and how much your wealth explodes after that first 100,000. And it has everything to do with the power of compounding. So please check that out on YouTube when you have some free time. Let's talk about this scenario. All right. So, for example, remember we talked about in section one, we were talking about saving money at home and the cons and the pros and stuff like that. So, if I'm saving money at home, I'm not earning interest, and assuming it's not lost or stolen, if I have 1,000, after 5 years, I have 1,000. After 10 years, I have 1,000, right? But what if we employed this idea of interest that's being paid to us by keeping money at our financial institution and having that money compound on a monthly basis. So very simply, you can see if we put $1,000 into the bank, and again, this is going to be depending on interest rates, right? It could be 2%, 3, 4, 5. Okay, but for this example, we're using 2, right? After 5 years, it's going to be $1,105.08. That's free money for you. But after 10 years, it's going to be 1221.10. Now, we're gonna oh, actually, let me back up real quick. I want to give you a scenario if the interest rate changed. Let's back up. Okay. So remember I said it's going to be depending on the interest rate. So what if I told you in our scenario here, I'm going to give you 4% interest and we're starting with 1,000. Okay, so check this out. With the 4% interest rate, after 5 years, that 1,000 grows to $1,221, which again, that's what we have after the 10 years if it was 2%. Okay, now that 4% compounded over time at 10 years is $1,490.83. Okay, but one last scenario. Let's say I gave you 6% interest on that 1,000. How much money would you have after 5 years of it compounding? Well, you would have $1,348, but after 10 years, you would have 1,819. That shows you the difference in what the interest rate could deliver. So it is skyrockets, if the interest rate's higher. But now I told you about compounding, right? Compounding is earning interest on interest, but we want to build savings and build wealth. So let me give you this next scenario. So we're going to build money by making a deposit, an extra deposit. So I want to show you this example of interest combined with regularly saving $5 a month. Now, we don't really need to talk about the saving money at home in our sock drawer or under the mattress or whatever scenario you want to give. We know that our money is not gonna grow. Okay. But let's talk about the interest side of things. So let's say 2% at a bank. Okay. So 60 bucks after a year will be $60.55. Okay. After 5 years, but now here's the thing. Not only are we going to do the 2% interest compounding monthly, but we're going to also do $60 per year, $5 per month for 5 years. Okay, so our $60 now grew to $315.24. Okay, but if we did this for a 10-year period, our original investment of 60 bucks has now grown to $663.60. Crazy, crazy. But let's look at that over 30 years. Our original $60 investment, while saving $60 per year for 30 years, grows to $2,463.63. Okay, I don't think we have it on the table. So let me verbally explain this because just like in our previous example, I gave you different interest rates. I want to give you different interest rates on this too. So remember, our idea here is combining interest on interest, but now we're setting aside an extra $5 a month into our account. So we're saving an extra $5. But that was at a 2% interest that I gave you in the right-hand table. What if we change this to 4%? Okay, so follow with me. If after a year at 4%, we would have $61, okay, and some change at 4%. At 4%, over 5 years, we would have 331. So see the difference, we're at 315 at 2%. So you can see how much the interest makes an influence on this. At 10 years, it's a big difference. We would be at 736. That's up from the 663 of the 2%. Now check this out. This is a lot different. It's an extra grand. If we move from 2% to 4% and we're still saving our 60 bucks a year. So after 30 years at 4%, we go to $3,470. Okay. Now, let me show you where this really explodes. I'm going to give you the example at 6%. Okay. At 6%, our $60 would be 61. But if we save $60 a year and we were earning 6% interest, after 5 years, we would have $348. Okay. Big difference from the 315 of 2%. If we did it for 10 years, we would have $819. Now, this is where it's really eye-popping. If we had 6% interest and did our $60 per year over 30 years, $5,022. So that just shows you how influential the interest rate is. Let's talk about APY next. So APY is the annual percentage yield. The APY reflects the amount of interest you'll earn on a yearly basis. It's expressed as the percentage. The APY is not the same as the interest rate. It includes the effect of compounding. So the more often your money compounds, the higher the APY and the more interest that you earn. So looking at the APY is the best way to compare your potential earnings from different accounts. Next, we have the rule of 72. This is just for the curiosity of understanding how long it would take to double your money. Okay. So you can divide the number 72 by the interest rate that you earn on your money expressed as a whole number. So the result is an estimate of the number of years it will take to double your money. The calculation assumes that the interest rate remains the same over time and that you're not making any withdrawals or deposits. So let's show you the example. Example one, if you have $50 in a savings account with an interest rate of 2%, it will take about 36 years to double your money to 100. So that is 72 divided by 2 equals 36. The rule of 72 gives you a quick way of estimating how long it may take to achieve your savings goals. There's another way to use the rule. However, you can use it to estimate the interest rate that you have to earn to double your money over a certain amount of years. So you divide 72 by the number of years. This gives you an estimate of the interest rate that you would have to earn. So let's turn our eyes to example 2. So what interest rate would double your money in 10 years? So we would take 72 divided by 10. That equals 0.072 or 7.2%. You would have to earn 7.2% on your money in order for it to double in 10 years. And if someone tells you they can double your money in a year, you'd want to ask several questions because it's highly unlikely, okay? That actually is going to bring us to the close for the section. And I said that we would cover 4 sections, but I think for time's sake, this would be a good time to stop because really the next section is specifically talking about how to save for medical things, like for unexpected items. I don't think we need to cover that right now. But the key takeaway from our section 2 is considering the advantages and disadvantages of the savings options before choosing where you're going to build your savings. And I think the most important takeaway from the section is understanding the compounding part of it. But let me put an extra emphasis on what you saw, not in terms of calculations, but more in terms of the most important factor. The most important factor in the scenario is not going to be the amount of money that you are putting into savings. And what I mean by that is it's not going to be the dollar amount that you're able to put into savings. It's not going to be the $5 that you do a month. It's not going to be the 3,000 a year that you put in. No, that's not the most important thing. The other most important thing is not going to be the interest rate that you're getting. It's not going to be that 2% on the account. It's not going to be the 3% or even the 6% that you're earning. Although we did cover how influential that interest rate can be in growing your savings over time. But no, the most important thing to remember and the most important variable is time. The most important variable at your disposal is going to be time. The more time that you have to save, the more impact you're giving to the amount of money, dollar amount wise, that you're saving in a month, and the more impact that you're giving to the interest rate to allow it to do its thing over time. So, the more time you have, that is the most important thing. And because time is the most important thing, it means that the earlier we can start saving, the more beneficial it'll be because it'll have more time to do its job, which is to compound over time. But there's nothing to be worried about. And let me tell you why. I myself only started getting serious about building savings recently. And when I mean recently, I mean in the last 8 years or so. So this is very new to me. So even with me being in my 40s, I still have the time on my side to allow the interest rate and the amount of money that we're putting in savings to do its job and compound over time. Okay. Which shows you that it's not too late either. I may have to put a little bit more money into savings now because I didn't start in my 20s or my 30s, but there is hope. If you haven't started, you still can. And even small amounts will be beneficial and they will compound over time. So at this time, I'd like to open it up. If we have any questions, let me turn my camera back on. Hello. Do we have any questions?
I don't see any questions on here. Um, I also want to share that I just started a savings account as well. I mean, I've been trying to save, but um, I know we just opened up like a Cal Savers account, so that's going to be deducting like, biweekly money.
Yeah.
I'm a little nervous about it. It's my second paycheck where they're taking out some money, so we'll see how it goes. But
Yeah,
hopefully,
it's tough.
hopefully this time around next year I'll have a nice little cushion.
Yeah, I mean, I think we all need to really try to find a way to start somewhere, right?
Mm-hmm.
It's difficult, but I'm telling you, $5 here and $5 there with interest compounded over a long period of time can really grow into something. So I'm glad that you started.
Yeah, we'll see.
Yeah.
It's a money market fund, so hopefully, yeah, I don't know the specifics to it, but I have to
Yeah,
look
you should
more
earn a
into
little
it.
bit more interest. So yeah.
Yeah, okay. Well, thank you so much, Tom. We appreciate you taking the time to talk to us today, and we'll catch you, I believe, is it next week?
I believe that is right. And we'll
Okay,
be talking about borrowing basics.
got it. Okay, sounds good.
Yep. All right, Ellie.
Alrighty.
Have a good
Thank
night.
you.
Enjoy the rest of the week.
All right, you too. Bye-bye.
Bye.